Welcome back to Morning Markets on Friday, the 17th of November. It's been a week packed with economic data, and so far, equity and bond markets have responded very well. This morning, we're going to discuss some important developments around inflation and employment conditions in the United States. Stay tuned and we'll discuss the detail. The yield on a 10-year US government bond has came down from 5% to 4.5% through the course of the week. That's quite a positive move in terms of the price return. Two data prints which have supported this trend. Yesterday we had the US Producer Prices Index, which moderated 0.5% month over month. So that's a moderation in terms of the prices in which producers are paying for their goods and input products. This was largely reflecting the moderation which we've seen in gasoline prices through the course of the month. If you were to strip out food and energy, there was a modest uptick of 0.1% month over month, but this is the smallest increase which we've seen since the spring. In addition to these and pressures which we've seen on pricing, we also had an update from the Labour Department. This was showing that the number of employment claims ticked up by 13,000 last week from the weekend in November the 11th, taking the total to 231,000. This level is well within the range which we've seen over the course of the last 12 months, the range being 194,000 to 265,000. So it's somewhere within the middle of this. The Federal Reserve themselves have acknowledged that the labour market has been too tight. It's been driving and stimulating the demand, which has been fueling inflation. So they've acknowledged that labour market conditions need to cool. So this level will have been welcomed by the Federal Reserve. To put this in context, however, as I say, it is within the range which we've seen over the course of the year, and the labour market is still very strong. There's 1.5 jobs available for every worker available in the United States. Unemployment is 3.9%. It's still some of the lowest levels which we've seen in a number of decades. And all of this is built on the developments which we saw earlier in the week, which was a material slowdown in the rate of headline inflation and a modest slowdown in the rate of core inflation. Consumer spending has been in focus yesterday. We also had a report from Walmart in terms of what they're seeing. Their chief financial officer demonstrated that their consumers were demonstrating greater discretion. They were making choices, they were substituting for lower cost items, and they were gravitating towards promotional marketing campaigns. But this was also helping them attract some new customers to the business as well. He did recognise that the consumer is softening in terms of their purchases, but did recognise that the easing pressure on inflation through the fourth quarter is helping sustain revenue and profit as well. So revised up their full year revenue expectations for 2023, 5.5% growth expected now compared to 4.5% when they were last asked at the end of the second quarter, and their profit outlook has improved for the full year. So a number of data points, but generally supporting the disinflationary trend and supportive for bond markets and equity markets. We look forward to bringing you up to date next week on Morning Markets. Enjoy the weekend.